So renewables is a good starting point for the transition to my presentation. Thank you very much, Michael and Wimco, for having me. I understand I'm the last thing between you and a glass of wine, so I try to make my presentation reasonably short. My name is Oliver Scharping. I work for a firm called Bantleon. We are a Swiss-German investment boutique with around 50 people. On the equity side, our approach is very much fundamental driven, and we are value investors by heart. So in terms of our philosophy, we lean in particular towards three things. We like low risk situations, as preservation of capital is key to our firm's DNA. We prefer higher quality assets rather than beaten down cigar butts. And typically, we look for a clear set of catalysts to unlock any value. We do this as a firm by investing across the whole capital structure. Here you can see that next to equities and equity-linked strategies, such as event-driven, we are also active in credit, where historically our roots lie, and we also do have a small quant team and consult our clients in tactical asset allocation questions. As a firm, we focus almost exclusively on institutional clients, which you can see on the next slide. Roughly 95% of our AUM lie with institutional clients, such as pension funds and insurances. And we also, however, do have some smaller funds open to retail investors and family offices, which make up around 5% of our assets. A very important part of what we do on the equity side is what we call event-driven value investing. So here we combine a fundamental value mindset with a clear catalyst orientation. And put on a slide, this then looks something like this. It's small, but I hope here you can see the sort of situations we typically invest in as part of our catalyst-driven approach. You for sure should recognize some of the logos in each of these situations. A corporate event is key to unlock value. The strength of the event varies here from the left, where we have the very hard catalyst situations, to the right, where the catalyst then becomes increasingly softer. And I will not focus on the very hard catalyst situations today, which comprise mostly merger arbitrage, although these are a very important part of what we do at Bantleon. And I would be very happy to later on chat about the likes of Fitbit, Tiffany, or Osram later on. So now I will present you an idea from the softer end of the catalyst side that falls for us in the value plus catalyst category. So let's take a step back and imagine for a second you could buy a leading future climate champion in a monopolistic position with a wide economic moat, a rock-solid balance sheet that is growing way above sector average, yet trades at a significant discount. So here we go. Yes, I'm speaking of no other than the German electric utility RWE. If you want so, it is the second ESG dark horse that we encounter today. And based in Western Germany, many of you might know this more than 100-year-old company for something like this. And as a matter of fact, RWE was the largest producer of CO2 emissions in Europe over the last decade. And the company has long been a top-tier target by climate activists, in part as a result of a long-running battle to preserve a forest in Western Germany that has been threatened by RWE's lignite mines. So here we see RWE's operations a bit more in detail. It is somewhat small to read, but on the left side in the pie chart, you see the net generation capacity split in gigawatt. Today, RWE does still operate some of the largest coal-fired power stations all over Europe. Lignite, coal, and nuclear make up more than half of its produced capacity. And from cleaner alternatives, such as renewables, RWE generates less than 1%, which you can, or not, which is on the top end of the diagram. Although it does have a financial interest in a company called Energy, which it carved out 3 years ago. So why bother? Here's why. In 2018, something remarkable started to happen. The two largest German electric utilities, RWE and E.ON, sat together on a table and agreed on a very complex asset swap that is set to fundamentally change the European energy landscape, and with it also the RWE as we know it. Here we see the asset swap depicted, simplified as much as possible. Basically, the deal will transform Europe's worst polluter into one of its largest renewables players. How does this work? RWE, here in blue, will acquire all of E.ON's, here in red, and Innogy's, here in yellow, renewable energy assets. This will transform RWE immediately into a sizable player, and after completion, the new E.ON in turn will concentrate on grid operations and end-user services, taking over all of RWE's existing power lines and grid holdings. Importantly, you see that in the middle, RWE will also get a 17% stake in E.ON in order to balance out the deal. This is the executive version of the swap. The number of single assets that is actually changing hands is much higher, and also the complexity of the deal is much higher. It took a while to really complete it. On this slide, you see the transaction timeline. I will not spend much time on this, but we are currently in the second and final stage of this transaction, and the outstanding key items are the actual transfer of the renewables assets as well as their full legal integration. And as you can see then on the next slide is that once the dust settles, RWE is set to become the second largest offshore wind operator globally, and more broadly in renewables, number 3 in Europe and number 4 worldwide. As we can see here, the swap let RWE jump several positions ahead in capacity rankings, and this chart is not even taking into account the massive pipeline of new solar and wind projects that will be taken on by RWE annually on top. So following the completion of the deal, the new RWE's overall generation portfolio will then be around 2/3 zero carbon or low carbon. As we are in the final innings, so to say, of this game-changing transaction, we do really like the new RWE and think it offers an attractive investment proposition at this very point of time, which we see here. In our view, the transaction creates a situation of multiple ways to win together with RWE. First of all, we think that as the asset swap moves towards completion, RWE can simply no longer be ignored as a prime renewables player. In fact, the already sizable renewables portfolio that we just saw in the ranking has scope to grow meaningfully from 2020 onwards, and the pipeline of new projects is very promising. So we think that RWE, similar to other climate champions such as Ørsted or NextEra, will be able to deliver high single-digit earnings growth over the next decade, which is more than twice than the broader sector average. I will talk about the second point, valuation, in a second, and go first right to the E.ON currency, with which I mean the 17% stake in E.ON that RWE gained during the transaction. We are fully convinced that RWE will not simply keep on this stake and hold it as a financial investment, but instead we see two options. The first one would be to re-leverage the stake by selling it down, sacrificing the dividend yield from this financial asset to fund instead the development of new incremental wind capacity, arguably the highest return activity in RWE's portfolio, with equity returns approaching roughly 15%. We just heard what this means then levered. This would crucially boost bottom line contribution and bring along significant upside to the valuation of RWE. However, the second, and in our view, much more attractive way to leverage the E.ON currency, so to say, would be to use it to ring fence its legacy operations. The legacy lignite and coal and nuclear business will produce negative EPS a few years down the road, and ring fencing these assets in a separate legal entity and pledging, so to say, the E.ON stake against it would be a way to strip out these EPS and equity value detracting items. Such a ring fencing transaction is nothing new. In fact, it has been done before for German nuclear liabilities as well as for German coal mining liabilities. Coming to the fourth point of the slide, nothing new here, but we do like utilities because of their monopolistic nature and defensive, non-cyclical return profile. And despite already this year, we think the sector is still under-owned. Last point here on this investment highlights. We do like RWE also because its asset portfolio is exposed to a large number of out-of-the-money call options. For example, we think that the market largely overlooks the meaningful dark spread expansion that could result from tightening of the German power market. It is where the decommissioning or the exit of lignite, coal, and nuclear at once would ultimately remove around 60% of very reliable baseload capacity in Germany. Without going into detail, this means that Germany and German power prices would basically getting out of 10 plus years of oversupply, and we think spreads could expand meaningfully and the EBITDA impact on this would be highly accretive. Another such out-of-the-money call option would be coming from a full lignite phase-out, which would leave RWE with a highly attractive long carbon position, which would be, in our numbers, at least worth 1 to 1.5 billion at a market cap of 16 billion, as RWE is currently hedged out, fully hedged out until 2022, and partially hedged out even over that period. Also, we believe that in connection with this early phase out of lignite and coal that is planned, the risk is definitely on the upside, as compensation for lost profits and stranded capex that RWE suffered is not properly, or at least too conservatively, accounted for in any consensus numbers that we saw. So where does that leave us with valuation? As you can see here on the left-hand side, the new RWE, adjusted for pro forma post-transaction numbers, is trading at the cheap end of its renewables peer group. Despite the solid performance in 2019, it is also still trading below the broader utilities sector. Even if 2/3, and this we see on the right-hand side, 2/3 of RWE's enterprise value in a pro forma sum of the parts view comes from renewables, the company is still heavily discounted by the market for its non-renewables portfolio in our view. So, however, after the completion of the transaction, we think that some of this negative overhang should be removed, and we assume a partial re-rating closer to the likes of Ørsted, Nextera, or Iberdrola. Conservatively speaking, about 20 to 30% upside just from this re-rating shouldn't be a big stretch. And as mentioned, we see significant additional upside from strategically using the E.ON currency. A re-leveraging, using the stake to fund new wind projects, would lift our return target by at least another 20%. On top of that, ring fencing solution, however, would be the true breakthrough and could easily catapult RWE's valuation very close to the pure play peers. And we do not need a calculator to see how that could, or to what that would lead. I spoke already about many of these points here. Very briefly, in the RWE case, we see the 2 points on the top as major reasons for the discount and the opportunity. The complexity of the asset swap and the mess it did to the numbers is a major reason, And obviously RWE does currently not make the cut for any sort of ESG filters, as the legacy asset stub is still very much in focus and in the minds of investors. Which also brings me to my summary here. We do like RWE as a fairly low-risk investment. We believe in a conservative case, it is at least 30% undervalued, and currently being in stage 2 of the E.ON transaction, right at a very crucial inflection point. Key catalyst is first the completion of the swap, which will result in a completely new investor and earnings profile. And thereafter, we see plenty of additional upside from further portfolio simplification, and we really like the set of out-of-the-money options that we get for free on top by owning RWE. Yeah, thank you very much. That was my brief introduction to the case. I'm happy to answer burning questions now or at the reception. Up to you. Thank you.
So are there any questions? No. Don't see any questions. I see one question.
So just out of curiosity, if this was such a great deal for RWE, why did E.ON agree to it?
Well, I focus in my graph on what RWE really got. It is not mentioned that they, for example, did a cash payment to E.ON as well. And for E.ON, E.ON also now has a very attractive position on its right, because they are now in a complete monopoly in the German market, if you want. So they control all the grids and can, like, basically they attract a very different investor profile, but they're also in a very attractive position, although maybe not as much exposed to future growth, but from a stability point of view, also E.ON is very well positioned from this deal. So it was win-win.
Does the European Commission have to also give their approval for this? Because in Germany they're tending to allow these champions to be created, but it still has to pass, I would say, through the Commission.
Yeah, there was actually a very long list of lots of very different approvals, but the key approval has been taken already. Like, there's another one outstanding. It is a risk, you're right, but in our view, it is rather low. A deal like this had extensive pre-discussions and pre-filings, so they didn't just announce this and send a letter to the authorities, but it was all pre-discussed.
Okay. Any other questions? No? Okay. Then I would like to thank you, Oliver.
Thank you.